Hello and welcome to today's webinar. So basically good morning or good afternoon or good evening depending on where you are around the world. Today is going to be a very, very exciting webinar titled Volatility and Realistic Trading Plans. My name is Brian. My consulting firm there you see is Jupiter Peak Financial. You have access to me via email there, and then I've also provided a website where I do some posting, and those postings actually get carried over to FX Street. So I'm just going to be bouncing around between a few different applications today, but I just want to make sure that you get that. But I'm going to show you where you can find this information directly within FX Street. So before we go any further, we know that we're all trading the markets and anything can happen anytime. We're trading leverage products, so that's very, very important. So I'm just going to leave this disclaimer up for just a moment. All right, and again, this disclaimer leads a lot into today's topic because we're going to be talking about trading plans and realistic trading plans. So that's the key word here is we're not doing anything without a trading plan. And if we do something without a trading plan in these volatile markets, we know that anything can happen. So we need to make sure that we take those cautionary steps to make sure that we're protected against any surprises or anything out there that could go contrary to our opinion. So really quickly, just about me, I just want to introduce myself because I think it'll help you as we go through today's discussion. I started out as a bond trader, a bond futures trader in the financial markets in Chicago as a scalper, meaning I was trading very, very quickly as many times as I could throughout the day as I saw opportunities. So it could be 10 times a day, 20 times a day, 50 times a day for very, very, very short periods of time. Technology changed things. We've talked about or heard about black boxes and gray boxes and news and things like that having different effects these days. So I had to adapt. So I left those markets and actually moved away from the market site and still trade, but I adapted to various markets, various strategies, and various time frames. So I trade different entities for different reasons. We might talk about that a little bit, but that kind of put me in a good place to understand what other people were doing and what other individuals were trying to get out of the markets. And so I founded Jupiter Peak Financial in 2008, which is a consulting company teaching individuals and trade and small businesses, money managers to profit or at least understand volatile times. And so the benefits of teaching for me are huge because I'm holding others accountable and I hold myself accountable. So I learn by doing. The more I'm talking, the more I'm writing, the better it benefits me. So I already wrote an article this morning because the markets weren't super active. And so that just kept me out of trading. So not to say that I might not trade in a little bit today after we finish up today, but there wasn't anything that was exciting to me earlier today. But we'll talk about that. We'll talk about different opportunities in the markets. And like I said, based on volatility, we'll build some realistic trading plans. So overall, whether you're a trader or you're an investor, I think that inflation is going to come back into the markets. I think that economic policy is affecting things, and nobody knows what's going to happen. Nobody knows the effects of austerity measures. Nobody knows the effects of quantitative easing. But I think people like you listening in today, that whether you're an investor for the long term and or you're a trader, I think that when we start to see volatility creep in, and that's the main word today, volatility creep in, when we see volatility, I think that you guys have the opportunity to do very well versus a long-term investor who is just buying and holding and holding and holding. So my approach to teaching is basically mirroring others, learning what they want to achieve, and then helping them achieve their goals using various financial markets, including foreign currencies. And again, it just depends on the individual and what they can handle and what they're looking for. But overall, the Forex markets are very good for a trader, and they're also a very good market for an investor as well because they can actually hedge equity investments. They can actually take advantage of long-term trends. So I don't just look at the Forex markets as short-term trading. I look at them how they're related to the overall financial picture. Your outline of where we're going to today. Fundamental analysis, we'll talk about that first. Then I'll talk about the VIX. We'll describe that. You'll be able to see that in a chart. And what does the VIX tell us? What does it tell us as a trader? What does it tell us as an investor? Well, then we'll go into the technical analysis of the markets, and we'll look at Forex markets, and we might even look at some relationships with equity markets, but we'll focus for sure on the Forex markets. And then we'll let the charts build us and tell us what to do. They'll basically build trading plans for us. We'll do a quick review, and then we'll go into something called Your Chance. So just a question came in, did you get scalped? I'm not sure what that means, but no. Scalper is obviously, I think most of you understand that you go for the markets, go for very, very short profits, multiple times. And so scalping, I think you can still do it, but again, that's what we're going to let volatility, we're going to let the markets tell us what type of trading to do. So let's just move into the fundamental analysis, a discussion of current events and what they mean for traders and investors. We'll talk about the Federal Reserve. I'll bring in a link from FX Street or a few links from FX Street, and then we'll talk about a few other news sources. But right now, what's going on around the world is there's government intervention. We've got to be paying attention to the macro big news out there. Quantitative easing, bailouts, austerity measures. Those are the big factors out there. And we're seeing those effects on volatility, which I'll show in just a moment. We're seeing those effects on the markets as our trading ranges right now are a little bit muted, even though there's a lot of uncertainty and fear and anxiety. It just seems like the markets aren't showing and reflecting that same uncertainty and fear and anxiety. A lot of people know that Europe, is in a very, very, very difficult place right now. And you would think that that'd be causing massive, massive moves in the markets, and we actually aren't seeing that. So we've got to let the charts tell us what's going on. So pay attention to the Federal Reserve. Pay attention to the European Central Bank. Pay attention to the Bank of England. Let us get information from the biggest traders out there who are basically making coordinated efforts and coordinated decisions together. If you don't know where to pay attention to this news, here's the website right here, fxstreet.com, and then you go to the fundamental section and then the economic calendar. And I can actually bring that up for you to see right here. So that you can scroll down and you can actually see the various news sources. So let me just pause while it comes up. And so this is the website here, the economic calendar. I pay attention to this every single day. It guides me. It's really my guide. Before I even look at the charts, I need to know what's going on in a macro scale. Then I can go to technical analysis. So what I'm doing is I'm providing you with fundamental analysis first, then we'll go into technical analysis. So this is the economic calendar, and it's just telling us what's going on. We actually had Ben Bernanke, the Federal Reserve Chairman in the United States, speaking today. Not too much as far as if we were looking for anything on the markets, but we just had to be aware that he was speaking right here. He's speaking just a few hours ago. Market not indicating any trend, almost absorbing the bears. Yeah, we'll talk about that. I don't know which market you're talking about, if you're talking about equity markets or a specific foreign currency pair, but there hasn't been much of a trend right now as far as the equity markets go, but there actually is a lot of support. So the bears aren't getting a lot of quote unquote love out of it. So that's where we're going to go back into is the PowerPoints, and we'll move into technical analysis. But as I move back into the PowerPoint, I just want to show you that you can find this news through the FX Street economic calendar and try and find articles then about what the Federal Reserve said or what Ben Bernanke said, or like I said, if the Bank of England was talking or setting an interest rate decision, or the ECB. You've got to be aware of that. You've got to be forward looking. So the FX Street platform is very, very, very powerful, and I urge you to use that to shape your fundamental opinion. CNBC, I know there's worldwide versions of it depending on where you're at and around the world. It's a TV station, and I don't use it to learn about a specific currency pair. I don't use it to learn about a specific stock. I learn about it to just help me if there's any breaking news. Is the ECB speaking? Are they doing an austerity measure? Is there a quantitative easing, decision coming on? So I look for it just to give me a big, big, big view that would affect all markets, not just one little thing, but all markets. And then I can go, and because I have a watch list and I watch my currency pairs, then I can see what they're doing and how they're reflecting that data. So I'm just looking for the broad news out there that would affect all markets that every single trader or investor out there would be worried about. Also, another TV station that has a very good worldwide view would be Bloomberg Television. So there's a couple television stations, and then obviously you can do so much deep analysis within FX Street. All right, so let's move on to the next slide. And VIX, this is what we're talking about, and I really, really hope that you've heard of the VIX, and I hope that you are able to keep an eye on it, because a lot of Forex traders don't watch this. The VIX is actually more important for equity traders and option traders, and so we use it every single day. And so like I said, I'm pretty well rounded. I have an investment portfolio. I work with investment managers. I have to let the markets tell me what to do. So the volatility tells me how often to trade, how large to put on a trading size for that specific trade. Am I playing defense? Do I want to be on offense? And the VIX is kind of my gauge, because the VIX is telling me how volatile and how the markets are. And it actually is kind of my opportunity gauge. So I look at the VIX as an opportunity gauge. The higher it is, the more opportunity I see. So let's go ahead and look at the VIX. And like I said, some of you who are specific Forex traders may not be paying attention to this, so this might be a bit of new information, and that's what this is about. I hope that this is helpful to you. So we're going to go into a chart, and again, I'll pause because I know there's a little pause between the charts popping up, and I'm going to go ahead and type in the VIX, and I'll just wait a moment for it to come up. So what does VIX mean for Forex trading? So that's exactly where I'm going, so thank you for asking that. And someone else put in there, it is a fear index. So what it is it's basically and again, I'm not going to go through the full definition of it because I want to talk about the technicals more so than anything else, but it's basically is a fear gauge. It's an uncertainty gauge. It's an anxiety gauge. And the higher it goes, the more uncertain things are. And so like I said, Europe, there's a lot of uncertainty, a lot of fear, a lot of anxiety out there. All right. But if you look at the VIX as it comes up, it's not that high. And I'm going to put it on a longer term time frame so that you can see it. All right. I'm going to put it out to a 1-year chart. So let me answer this question. What does the VIX mean for Forex trading? Like I said, it's opportunity. The higher the VIX is, the more uncertain the things are, and the larger the trading ranges are, the more conviction someone might have one way or the other because there's more movement. The lower the VIX goes, the less opportunity there is because trading ranges are smaller, because there's less conviction, because traders know that there's less chance of movement. So think of the VIX as percent of movement. The higher the VIX is, the more chance of movement we have. The lower the VIX is, the less chance of, that there will be movement. So I'm just going to flip this and just take a mental image of the VIX right here, okay, and see how it's been going lower and lower and lower and lower. And just over the past week or two, it's been going higher. And traders, we always focus on percentage, and in the past couple of weeks, it went from 15 to almost 20. A $5 move of a $15 entity is very, very large. So keep that in mind. So please keep that in mind. So we are looking at the VIX, and if you take a mental image of that, I'm going to back this up now, and I'm going to type in the equity markets. I'm just going to do a broad measure of the equity markets. A lot of people pay attention to around the world, the S&P 500. And like I said, it's going down, 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 and then just lately, it started to pop up. Okay? So that's the VIX getting lower, and then finally just popping up. And percentage-wise, it's had a pretty good move to the upside. So we focus on percentages. But the point is, you can see that it was a lot higher. Remember last summer when you turned on the TV or you turned on your tablet or the computer, Europe, they were rioting in the streets and things like that, and volatility was in the 40s, all right? And then all of a sudden, everything was fixed. Everything's fine, and volatility goes down and down and down and down and down. Now I'm going to put in SPX, okay? And I'm just going to switch the chart. Last summer, the SPX was down here on its lows. Now, the SPX is way up high on its highs. It's gone higher ever since last summer, and all this uncertainty in Europe. And nothing's changed. There's still more uncertainty as of the past couple of weeks in Europe, and the incumbents and things like that, they're being voted out because people want change, and nobody knows what this change is going to do. It's lots of fear, lots of uncertainty, lots of anxiety that's not going to be fixed anytime soon. Yet the markets are sitting on their highs. And if you look, we focus on trading ranges. How much opportunity is there every single day? So if you work back from right to left and look at these trading ranges, they're a little bit bigger right here just the last couple weeks. But if you look back in April and March and February and January, these trading ranges are very small. The VIX is going down, and the trading ranges are very small. Last summer, when the VIX was high and in the 40s, look how big these trading ranges are, okay? So that's what I'm telling you, is the VIX is your opportunity gauge. The higher the VIX is, the more opportunity. We're moving 2, 3, 4% in a day in the stock market. And then all of a sudden, in January, in February, in March, as the VIX went down and down and down, we're moving like 0.5% each day, and we're just grinding our way higher and higher and higher. So just a rule of thumb is, as the equity markets go higher, the volatility goes lower. Day traders have to be more picky. There's still opportunity out there. There's still incredible opportunity out there. It just may be more infrequent. You guys have to use volatility to give you realistic expectations. Okay? So I'm just going to pause here, and I'm going to change this application, and I'm going to move as we segue into foreign currency. But I think that this is important for you guys to understand, that a lower volatility usually means a more bullish equity market, usually means smaller intraday movements. Okay? So let's move back now, and we'll segue into foreign currencies. So just let me pause and make sure I bring up this application for you guys to see it clearly. All right, so we're moving on from VIX. We understand what the VIX means for us now, and we're moving into technical analysis. What are the traders doing with the fundamental news? What are the major trends, major supports, and major resistance? And me personally, I stick to the majors. So I'm going to show you a couple different majors. We're going to go into the US Canadian, and we're going to go into the Euro US dollar, and we can go into some other pairs if you guys would like. So that's where you can type in and say, hey, can you please review this? But what are the traders doing with the fundamental news out there? All right. So let me just pause as I bring up the foreign currency markets, because that's why we're all here today. All right. Okay. So what you guys should see now is foreign currency charts. And again, there are no recommendations here today as far as brokers or anything like that. You guys know, just as that disclaimer came up, no buy, hold, or sell recommendations, no recommendations as far as various brokers. You guys have to do your due diligence and understand what's right for you. People listening in today are all over the world and obviously are trading different time frames and things like that, and trading for different lengths of time. So different products, depending, you might not be trading any of the products that I'm trading because you might be in a different place. So make sure that you guys do your due diligence as far as who you're working with as a broker, what's best for you and your individual situation. So let's take a look. Like I said, I want to look at the U.S. Canadian first, and I want to focus on the trading ranges. Remember what I said. Last summer, it was more volatile. The VIX was higher. This summer, leading into this summer in the spring, January, February, March, and April, the VIX was down, the equity markets are up, and we've been less volatile. So if you look here at this chart in the same time frame, look at last summer. Here's May and June and July and August and September, okay? Look at the trading ranges and how big they are. They were hundreds of pips each day, 75 pips, 100 pips, 150 pips, 200 pips each and every day. And I'm just bumping back to a question here really quickly, so that's why I'm pausing. Are FX futures better to trade than spot Forex? They're very, very similar as far as the charts go. But obviously you're dealing with a little bit extra leverage when you go into futures. So again, it depends on your account risk and how much you're willing to risk and stuff like that. So no, I don't see a difference as far as the actual technicals of it. I just see a difference as far as the mechanics of, can you afford to trade the futures? Just keep in mind that futures, obviously, you don't get stopped out. You know, you can put stops in, but if it keeps running and you don't trade with a plan, you don't have a stop, it can run and run and run forever. Where obviously with cash, they put these stop gaps in, and your account basically can't go negative. You can't over leverage it with most reputable brokers. I don't know about every broker out there, but most reputable brokers won't let you over leverage your account. So just make sure that you're trading appropriate for your account size, and we'll talk about that in a moment. So look at the trading ranges here when the VIX was higher last summer, and now look at the trading ranges. Look, I'm going to draw a trend line on here, a horizontal line, and we're going to start basically in the middle of January, and I'm going to draw one more. And so what I'm pointing out is January, February, March, and April, 4 months, we went from 98.80 on the bottom to about parity, maybe parity plus 50 pips. So basically, let's round that to about 175, 200 pips. Instead of 200 pips per day, we moved 200 pips total in 4 months. Up, down, up, down, up, down, up, down, up, down. That's it. We were in a 200 pip range. So what my point is volatility guides my trading decision. With volatility being low, with quantitative easing measures being out there and supporting the equity markets, and equity markets going up and up and up, and no fear and no uncertainty and no anxiety out there, when we look at the volatility gauge, is it fair for me as a trader to say, I expect the US dollar Canadian, I think I can make 200 pips today? No, you can't make 200 pips today because each individual trading day only traded about 50 or 75 pips, and it worked its way down and up and down and up and down and up, and it stayed in a trading range. If you understand how to read a trading range, you could buy support, put a stop in below in case it broke support because there's no guarantees, and you could sell it short at resistance, put your stop above, and get out in case it broke above resistance. 4 months, you guys, we were in a 2-pip range. That's not a lot of movement compared to when you have a higher volatility and you're moving hundreds and hundreds and hundreds of pips up and hundreds and hundreds and hundreds of pips down. This is a minuscule trading range. We broke out down to the downside just a little bit as oil prices crept up, and then all of a sudden, intermarket relationships, this is what I focus on. The equity markets roll down, bad economic numbers, oil prices go 108, 105, 103, 98, 95, and the United States dollar goes 98, 99, $1, $1.50. So 3-penny move up for the US dollar as equity markets went down, as oil prices went down. So there is an overriding relationship that you guys all should be aware of. When equity prices dive, for the most part, the safe haven has been the US dollar gets strong. I can prove that to you by looking at the pound versus the US dollar. And yesterday, in yesterday's trading, equity markets dove and then equity markets rebounded. The pound dove and then the pound rebounded against the United States dollar. Today, equity markets are up and now they're coming off a bit, but for the most part they're up. The pound went up against the US dollar and is stronger. So there's this overriding relationship that we can be aware of, and that's why I think that you should be well-rounded in understanding what other markets are doing, understand VIX, maybe even understand, options and things like that. It's very, very valuable to people who are traders and investors. So let me just pause a second. Someone just mentioned, Rocky, a more swing trade opportunity. So I'm not sure if you're asking me to identify a more swing trade opportunity. And swing trade, can be different for different types of markets. But if you're a swing trader and you see that futures are up today, and the equity markets are up, well then on this chart that I'm showing right now, you probably want to be a buyer. As long as equity markets hang in there, you want to be a buyer. So the trend today was up, and then it sits back a little bit, and maybe you can draw your Fibonacci or do some kind of analysis on there and say, hey, as long as equity markets hang in there, the pound should hang in there. The trend's up. I want to buy the trend at a discount. Maybe you're looking to buy it at 38%. So I'm a trend trader. I like to go with the trend. Yesterday, the markets were down. They rallied. The equity markets rallied. The pound went down. The pound rallied, and it came up to this 78.6, 76.4 Fibonacci. And I'm not saying that's the holy grail or anything like that. Again, no recommendations. But the point is, if you're a trend trader, you're looking for the trend to retrace and then get back in with a swing trade in that direction of that trend may be. Again, swing trading, intermediate trading, day trading, scalping, whatever it is, you've got to use realistic expectations. So as a swing trader, is it fair for me to say I'm going to get 100 pips? No. In these markets that are a little bit less volatile, if I can get 10 or 20 or 30 pips in a day, I think I'm a hero. I think I'm an absolute hero if I can work a 10-pip trade or 15-pip trade, because that's realistic right now. So like I said, realistic expectations. What is the maximum leverage in futures? I'm not going to get into that because that's kind of getting off. We're talking about volatility and trading plans today. So make sure, like I said, if you're looking to get into futures, that's a really independent question. That might not help everybody. So I think that, that's for your individual situation. I would dig into that. Futures FX is more transparent than spot. and that is why most spot brokers don't offer futures. They cannot trick traders in futures. I don't believe it. I don't think that anybody's out there to get me. If I have a loser, it's because the markets, got there. So, and they were going there. So I put in a trading plan. I'm either going to have a winner or a loser. I'm going to manage it to the best of my ability. So whatever market is best for your individual situation. Markets are supreme. We need to respect them. Absolutely. That's why it's location, analysis, and updating analysis. I like to say that I massage my trades. I'm constantly massaging my trades. So I want to get into the euro US dollar. Oh my God, the euro, it's going to go away. The Greece is going to go out of the euro. Oh my goodness, woe is me for the euro, right? No. Look at the charts, you guys. Let the charts tell you what's going on. If there's a euro to trade, we're going to trade it as long as there's opportunity. Again, look at what it's been doing over the past few months. All of this volatility, all this uncertainty, and the euro basically is in this 1.29 to about 1.34 range. It's in a 4-penny range, 400 pips. For me to go out and say I'm going to make 1,000 pips, well, I better be willing to put in a trading plan that builds in a lot of time for that to happen. If I think the euro is going to continue to go down, it has been in a downtrend, and I think it's going to break its low down here at 125, then I'm going to risk 400 or 500 pips to make 500 pips, 1,000 pips, 1,500 pips. But right now, there's support in there. Someone mentioned it, that the bears aren't getting that much love. There's not that much love if you're bearish on the euro because it's hanging in there. There's not that much love if you're bearish on the S&P 500 because it's not really going down. It may go down more tomorrow. We could get an announcement that could change that tomorrow, but we're constantly updating our expectations and things like that and massaging the trade and managing the trade. So right now, the euro is right here. It's in a very, very quiet range, and as long as you understand the bottom of the range or the top of the range and you're trading realistically and taking realistic profits and putting in realistic stops and having a good risk reward, you're doing okay. So let's just use the charts for what they are. They're based on fact. Let's use those facts and let's build trading plans. All right. So that's what I want you to see is you guys can now look at the VIX if you haven't been to understand that, hey, it's not fair for me to ask for 50 or 60 pips right now when trading ranges for the entire day are 50 pips or 60 pips or 70 pips. That's what I want you to see. These markets are very, very good. I love trading every single day and looking for opportunity, but I'm not expecting to have this huge, big day. That's just not what the markets are telling me right now as far as making 100 pips or 200 pips or making 5 trades or 10 trades or 15 trades. Maybe I only make 1 or 2 trades a week. It all depends. Every day is a new day, but I take it realistically with what's going on. Okay? So I'm going to go ahead and switch back into the PowerPoint. So just bear with me. What percentage of your account do you put at risk per trade? I'm going to answer that. And do you use more lots when volatility is low? Yeah, I'm using more lots when volatility is low because obviously I'm not expecting the move to be as big. So that's pretty good analysis there. Yeah, you can bump it up a little bit, because I'm not trading as frequently. I'm not expecting it to be a big move. I'm not expecting there to be slippage and things like that. So I might bump it a little bit up there once in a while, just depending on the day. So yeah, and that feeds into what percentage of your account do you put at risk per trade. Me personally, I do about 1 to 2%. I might put that up a little bit because remember, I'm trading various markets and I'm looking at, sometimes I'm hedging, meaning I'm hedging an equity portfolio. And if I see a relationship between foreign currencies and equities, and I think equities are overbought, I might put a defensive trade on to hedge a portfolio, an equity portfolio, to protect the downside of that. And so I might bump up the trade risk a little, the account risk a little bit there to maybe 3 or 4% because it's a hedge. So I don't mind losing that 2, 3, 4% because if I lost, hopefully it's because the hedge lost because the portfolio gained in value. Again, no free lunches, no guarantees out there, but I'm trading not just a day trader looking at it. I'm looking at it as opposed to an entire big portfolio. And so sometimes it's a day trade with 1% of the account risk. Sometimes it's a hedge with 2 or 3%. It all depends on the trade at that time, but generally not more than 4%. So that's a very, very good question. So let me just bump back in here into, as we get ready to wrap up, into these slides here, you guys. But very, very good questions, and thank you for that. I do appreciate that. I think you guys are a very educated crew, and you guys are spot on as far as the question. That was very, very important. So technical analysis, I think we covered that, but again, it stems from the charts, it stems from fundamental news, it stems from the volatility range. So using those realistic trading plans to using charts, I think we just did it. Use the charts to tell you what's realistic, where to get in at a good location, where to put an appropriate stop, where to put an appropriate target. I think you were able to see that in the U.S. Canadian. That was in that 2-penny range, up, down, up, down. It was very clear to see support, resistance. You don't want to be trading in the middle of that very tight range. Your chance. I work with individuals out there that I want to do this very, very quickly. You are the system. You guys are pretty educated, that person that asked that question about account risk and things like that. You guys need to know who you are first and what you can afford. Can you afford to go trade Forex futures versus Forex cash? That's different for every single different situation. I provide the chance to get grounded. It's a very, very, very small amount of time, but it basically is my unbiased review of your personal situation. And then I give you guidance of what I think your account risk should be, what your trade risk should be, your trade frequency given how much time you're going to be in front of the markets and what the market's doing right now, your trading time horizon, your trade management for your specific style. And then I open you up to, hey, based on you having your Forex account might be a smaller part of a larger equity portfolio or 401k or company stock, whatever it is. I open you up to other intermarket relationships you're paying attention to. It's a free, no obligation chance for you to just be able to Skype with me or get on the phone with me, and I can run through this and spit out a nice clean sheet that basically summarizes what I think you should be focusing on in individuals. So if anything else, spend that half hour with me. Hopefully it helps you to get grounded. I'm happy to offer that my time to be with you for that. So to review, my approach to the markets. I'm looking at how they interrelate. I'm trying to find trading edges based on the overall markets and the intermarket relationships out there. Fundamentals, use the tools such as fxstreet.com, a very, very, very strong site. Use the VIX to help you be realistic. Technical analysis to always update our expectations and help us manage that trade and massage that trade. So that's the information out there that hopefully you're able to take away. Resources. Like I said, I write for FX Street, and I'm going to actually put that information up there in just a moment. But I do have a daily blog, daily market commentary that I write, and this information goes right over to FX Street. So I want to show you that link so you can find it right there. I also do recordings for different brokers out there. And again, I'm not making any recommendations of any brokers. I just have relationships with certain brokers personally, but it's not a recommendation for you guys by any means. But that's a website there that you can find that. And then, like I said, those engagement interviews, find out what you as an individual trader and investor can achieve, handle, focus on for your trading personality, and that's how to reach me. So let me, as we wrap up here, I'm just going to change the screen as I look for some questions, and I'll show you. Am I on Twitter? No, I don't use Twitter that much. Email me because I'm on Twitter, but you can email me. Do you have a preferred time to trade the U.S. Canadian? I'm here in America. I'm actually near the West Coast. I trade during the U.S. equity open and the European equity close or end of day close. So I'm trading around 9 a.m. to 1 p.m. New York time, if that helps. 9 a.m. to 1 p.m. I like to see the U.S. markets get ready to open or open. I like to see economic data. I'm not a news trader. I trade in reaction to news, so I don't want to trade during, an unemployment report or an initial claims report or a CPI report or anything like that. So I try and let that news go, and then I react to it after. I try and absorb that data. So I trade as the U.S. equity markets are basically opening up for those 4 or 5 hours, depending on the day. Overall, what's your opinion on the euro crisis? Funny you ask. Let me just bring up the FX Street page, and then we will. I'll jump into that question, and we'll be able to wrap up. So let me just get back here. So this is my page on FX Street that you can link to, and like I said, my feeds that I write over at my personal commentary page get fed in here every single day. So there was this is Wednesday's the last article that I wrote. I actually wrote one this morning that hasn't gotten over here, or maybe I haven't refreshed the page, but let me just bring this up for you guys to see. While I was talking, I forgot to click on the little button here, so you guys should be able to see it in just a second here. Okay, so you should see it up here, but you can just Google my name or search for my name within FX Street. You should be able to find it, but I do post 4 to 5 days a week here that gets carried over. It's a very macro view. It looks at equity markets. It looks at options because I'm trading those. It looks at foreign currency and the relationships between them. So it gives you this big overall macro view of what's going on, and then I build in the charts and I bring in specific charts for foreign currencies and equities. As I'm scrolling down here, hopefully that you can see that. So I do take pictures of charts and I do analysis of the macro fundamentals and then some micro technicals. So someone asked a question about the future of the euro crisis. I was actually on a panel yesterday down at the Governor's Office of Economic Development here where I live, and I was on a panel about the euro crisis, the future of the euro based on the euro debt crisis. And everybody on the panel, the people from all over Europe, and business leaders and consulates and people associated with the World Trade Centers in various countries, they all believe that it's going to be a long road. There's a lot of uncertainty, so we talked about that. That's good for us as traders as the volatility finally does pick up at some point. But the point is, most thought that the euro is going to be there. There's no reason for countries to leave it. There's really not much upside. Yeah, they might lose a country like Greece or something like that, but France and Germany, the biggest ones, they don't want to leave it. They don't want it to dissolve. They want to support it. So most people there in Europe, they want it to be around. There are a few outliers, obviously, but they want it to be around, but it's definitely not going to be any short-term road to this austerity or growth or whatever these new governments are going to try and do. But they are committed to working together. That's what they said, is the Euro leaders in those different communities out there, they are committed to making it work. And there's a lot of, even though they're different countries and different democracies and things like that, they are working there. No, Ben Bernanke wasn't there, but it was very, leaders of different regions, in different countries were there because obviously this is their business and obviously the euro affects it. So we were talking about hedging strategies and interest rate risk and things like that. China's been backing the euro. There's been coordinated efforts everywhere. So even the United States has a little bit in there. The UK has a little bit in there. French and Greece people have spoken, like it or not. Yeah, like I said, a lot remains to be seen, but like I said, as traders, let's look at it as a good thing. If you're an investor, let's look at it and maybe be cautious, but know how to profit from that or protect your portfolio from that. But as traders, I think it's only gonna be good for us. So let's look at it. All these people in there were business leaders and things like that, and they're scared, and you and I are in there going, hey, this is a dream to me. So I think that it's only going to be more volatility for us, and that's what we want. We want volatility, and there's a lot of uncertainty out there. So the point is that volatility gauge, that fear gauge, that uncertainty gauge can get higher. So hopefully we have larger trading ranges someday, but right now we have smaller trading ranges. Let's trade accordingly. So thank you very, very much for your time today. I appreciate your great comments. Very, very educated crew out there. Continue to use the resources that FX Street provides you guys. And like I said, please read my daily market commentary there and take advantage of the other commentary on there. And I wish you the best of luck trading. And I look forward to speaking with you again on another FX Street webinar. Have a great day or a great evening, depending on where you are in the world. Thank you.